All right, everyone, welcome back. We've got Tom and Brian, and I'll be referred to as the dude behind the camera here. One of the most common questions that we keep getting here is diversifying. And this is actually a question I had way back when we were meeting in the infamous cafe back, it seems like forever ago now. I feel like we hear the word diversifying all the time. Like, hey, let's diversify, let's do that. But like, I feel like the approach that you're describing to me is a bit different, or maybe dramatically different than other things or other approaches that I've seen. So would you mind starting off I just had the question for you. What does diversifying mean when it comes to dividend investing?
All right. So first of all, you said I was a little different, so I got to attack that. Our method of diversification is pretty simple and also very complicated at the same time. So when I try to answer, you guys are going to try to keep me on track here. I'll try to keep it concise. But picture yourself as a redneck hillbilly out in a pickup truck, and you want some redundancy, right? So we want some redundancy. So here's what you're going to do. You're going to buy a pickup truck. You got a spare tire in the back, but just in case that pickup truck has a problem, you got a quad in the back as well. So you got your 4Runner back there. They're all full of gas. Now, if you're a real redneck, your pickup truck's got diesel in it. So you
And
might
a
have
shotgun.
yeah, and you might need to have like a cow horns on the roof. But anyway,
If you're
so
in Texas.
if the pickup truck breaks down, you got your quad. But if the quad breaks down, then you got your bike. Now, it can't be one of these newfangled e-bikes. It's got to be a regular, good old-fashioned mountain bike. I don't know what rednecks bike.
I don't know if they bike with mountain bikes.
And if that breaks down, then you got your rollerblades. So you got like 4 things there in case something happens. And that's really not what diversification is about at all.
I have no idea where you're going with that.
The point is that when you're buying a stock and you're buying a company, people ask me that question a lot, and then they ask both of us the question, well, why not just buy an ETF or an index fund? Well, when you buy an index fund, that's a great question. When you buy an index fund, you're paying for people to research all that, and they're supposedly very smart people, and if you want to do the same thing that everybody else is doing and exactly get the same performance that everybody else is doing, you just do what everybody else does, and then you exactly match what the index fund makes. We don't want to do that. We want to beat it. So in order to do that, you have to do something different. You can't do the same thing that everybody else is doing and expect different results. So with regard to stocks and with regard to diversification, when you look at the performance of a company in relation to the market, you're in a specific business sector. And that business sector will do good or bad, depending on what the economy is doing at the time. So if you're buying a stock and you're buying a company that's supposedly in a diversified portfolio, which you'll find out, in fact, even if you look at our portfolio, you'll find that if you've been watching this channel and you look at our past videos, the stocks that are doing really well this year actually were doing pretty bad last year. And now the ones that were doing really bad last year are doing really good this year. And there's a reason for that. And the reason why we look at individual stocks that way is if you buy an index fund, just like we talked about a few seconds ago, you cannot take advantage of the 52-week lows or the 52-week highs that hit individual stocks. If you have an index fund or an ETF, well, you're stuck with the ETF, and it's up to the portfolio managers to take advantage of that.
Right.
So how I'm understanding this is the approach taken to diversification is it's different than an ETF or an index fund because it's not reliant on the market as a whole. You're actually taking more control of the diversification for your investing yourself. Is that what you're saying?
Yeah, what you said was key, taking control of the diversification. Where when you buy an ETF, you have zero control. You buy it because you don't know what to do. Hopefully these guys know what to do, and you're willing to pay the extra premium for them to be able to do it for you. But if you can do it on your own, then you could keep those premiums and get a better percentage.
There's this picture. You can't tell me what to do. Grabbing all the stocks, he gets in his pickup truck and he promptly drives off a cliff. Don't do that. So Brian and I have been investing for more than 20 years each. So when you're looking at the stock and you're looking at the methodology that we're using to this. We're taking advantage of those individual companies. And if you pull up some of these companies, like I said, especially the worst one on our list here, Devon, they were doing pretty good at first. They went up, then they went down, and as a result, now they're our worst performer. When you looked at Intel when we bought them, they at first stayed flat. In fact, they went down a little bit. Now they're doing really good. There's a reason for that, and it doesn't, you always hear the word diversification, everybody talks about it, but they don't really understand what that means. If you really want to know what that means, you could take a look at the macroeconomic situation, the economy as a whole. What happens when the stock market's doing really well to certain business sectors, and what happens when the stock market's not doing so well? What happens to those same companies? As an example, during the Great Recession, banking stocks and real estate got destroyed. And companies that had been doing really good, like consumer commodity companies, Campbell's Soup, Johnson & Johnson, they didn't get affected as much. Well, why is that? Well, most people have to shower.
Right.
Most people.
When the
Most
economy is
people,
doing
right.
well, you tend to spend money on extravagant things that make those stocks go up. The company does well.
So when it comes to this dividend investing specifically, you're talking about looking at the market as a macro and understanding that when one industry is being hammered or really low, chances are there's another industry that is doing very well, right? And so with that, I actually wanted to ask, you were saying, let's show the portfolio of what we have in there. And you mentioned there's a lot of different industries. So tell me, what's kind of the methodology? Give us a high level picture of what's going on in the portfolio.
So it's hard to tell this because the portfolio is pretty new, but the direct correlation is I'm kind of pivoting off of my personal portfolio and Brian's as well. So we have a bit of a mix of what's going into it. As time goes on, this is only 18 months in, and this is based on originally a $400 a month portfolio. If you look at the companies in the list here, our first one is Devon Energy Corp. They're an energy storage utility company. The next one we have is 3M. They make adhesives and paper products and everything.
Right.
The next one is Kimberly-Clark, also a paper type company. Toilet paper, if you kind of have to have toilet paper.
Among 1,000 other things.
Yeah. Yep. Next one, Chevron, is an oil company. You can see that. Coca-Cola, they make drinks. Pfizer, that's pretty easy to know what Pfizer is because they advertise everywhere.
Sponsored by Pfizer.
Everything's sponsored by Pfizer. That's a pharmaceutical company.
Brought to you by Pfizer.
We got a regional bank, Comerica Bank, in there, and that was a tight play when we bought that one between a bunch of other regional banks. Campbell's Soup was another one. They are, well, it's soup. It's Campbell's Soup.
It's foods.
Company. They make soup.
Yep.
Actually, they do a lot of tin packaging too, so they're a metals-based company. AT&T, if you don't know what AT&T is, you probably don't live in the United States. So
Telecommunication.
yes, telecommunications, services, phones. ADP, they do data processing, and data processing is like payroll. They do checks and accounting for a lot of businesses. In fact, ADP, I still think this is the case, but they do a lot of that for Google.
Yeah, so large business and small.
So there's a wide variety of industries as I'm hearing it here. And so the thinking behind them, like, explain how each of these, how this in your mind is the right way to approach diversifying. Because I'm hearing a lot of different commodities, it sounds great, but like, how does that equate to this approach you're describing?
Well, I think if you're going to ask the Reddit crowd, they will take all their money and put it into one stock, because when that one stock goes up, you make a ton of money, right?
Or an ETF.
Or an ETF. But the problem with that is also when that stock goes down, you lose a ton of money. And it's a very stressful way to live. So the diversifying this way, we cut that out.
Yep.
So that when one sector is doing bad, another sector will take care of it, and it will make it more of a flat upward climb.
And these same people on Reddit will tell you too, well, I bought SCHD, or I bought JEPI, or I bought these other ones, and those aren't necessarily bad plays, but you are really counting on the management team there, and you pay them for this. It's in the fee of the ETF in itself, and maybe even the profit that they make. I've had people talk to me about, oh, they do covered calls in this particular one. That's great, but you don't have any control of the individual businesses that are in there, or even any voting share or say, or any ability to take the dividends and move them somewhere else. You are counting exclusively on, and some of the ETFs, I know they do pay dividends. There are actual investment dividend ETFs out there.
Yeah.
But most of them do not. So you're just stuck with the basic.
The ones that you hear about, the ones that are getting all the press and all the people are talking about are not the ones that are the safe ones that you just go in for the 60-year haul and it gives you an 8% return. These are the ones that are giving you the 14% return at the moment that people are clinging to and are throwing all their money into.
Yep. So in those ETFs, in those like 401k funds and stuff. Now, if you're not maxing out your 401k, I'm going to caveat the whole video, and maybe we should do a video on 401ks and Roth IRAs and stuff in its own right. But if you're not maxing that out, do that first, because that's all tax free.
Right.
So
you got tax advantage.
If you're doing that and you're still got some money left over, then we can come back and we can talk about this. But in those the individual stocks, what you can't do with an with an ETF or a index fund that you can do with an individual stock is you can take advantage of these market gyrations that take place. And if you're buying a company, a good example, one of our best performers is Intel. I got to find it on our list here. There it is. When we bought them, they were at a 52-week low. So this is wow, we're going back like 40 years here. Let me change this to something a little bit more current. I've held Intel stock since I was 3.
I did the lifetime because I wanted to see the ups and downs comparatively.
And they are many. All right, so here we go. We'll go back 2 years. So if you look at Intel and you think, oh my God, they went way down, but we bought them at the 52-week low. So if I've held Intel stock for many, many years, and they've paid me a dividend for many, many years. And by the way, that dividend has gone up most of those years. So when you buy a diversified portfolio, and you'll see you've got in our portfolio here, what do you have, like 16, 17 stocks, something like that now, close to 18. But when you see that, a good example, we talked about the housing market and banks. When the recession happened, the banking industry was affected because why? The real estate market, people weren't paying rent. They started foreclosing on homes, and the bank isn't getting money for all that. So what originally happened to REITs in the real estate market started affecting banks. And you could see the dominoes start to fall, especially if you had one stock in each one, or maybe two, in each one of those business sectors, and you could see that in your portfolio. But if that's all you had, you're having a bloodbath. I mean, you're getting destroyed.
So two things. There's a key in there is not diversifying for the sake of diversification. It's thoughtful diversification. I can't say diversification.
3 times fast, Brian. Ready, go.
Diversification. I can't do it. So it's thoughtful diversification. You have to pick a company that is a good company. Hopefully it has been beaten up, it's low, down, so that you can gain some value out of that as well.
Relative to their earnings.
Right.
Beaten up relative to their earnings. They got to still be profitable.
Right, yeah, not just a terrible company. It's got to be a good company. The other thing was, if you are diversifying within an industry, one industry, that's not diversification. That's still buying one industry. So when that industry drops, most of those stocks are going to go down anyway. So,
and this goes for all those crypto channels out there, and I have to apologize. Crypto, when it's regulated by the Fed, could be a good investment. But if all of your stocks are crypto, you are not diversified. Have one or two, and then buy other companies. Because otherwise, when one company goes down and the sector goes down, normally another business sector will do well. And you can pay attention to that if your own portfolio will see that. Banks go down, consumer commodities go up. And that actually happened during the Great Recession. So Campbell's Soup during the Great Recession, and ADP and Coca-Cola and all the really boring companies did really well. But the super high-flying tech stocks like Apple and, well, Tesla wasn't really around back then, but some of the less fundamental businesses out there that sell products that people have to have, those did really poorly. So if you're diversified within that, you might have a few that do bad, and just like our portfolio, you're going to also have some that do really well that offset the ones that do bad. I'm sorry, go ahead. You were asking a question, so.
Oh, you were good. You're good. That was actually a great explanation. Thank you. So I was going to ask, when it comes to choosing these industries, because I love the themes that are coming out here specifically about like, you can't, if you're buying multiple in the same industry, that's not true diversification. So when you say you're diversifying, are you actually looking for opposites? So you buy one company and then you're looking for, as much as possible, the opposite industry from that company? Is that how you're going about this?
Or one that would be affected by it. A good example could be somebody says, well, I'm buying a Ford as a stock, and I'm not knocking on Ford or GM or any one of the other, like we have Honda Motor Corp. Now, if you are an investor, you're not looking at the individual corporation, you're looking at the products they produce that the people will buy. And in this case, Honda makes a lot more than just cars. So if we just stick to just cars for just a second and we stay in that realm, instead of buying the automotive company, you would want to buy the supplier to the automotive company, because that supplier can supply to multiple automotive companies and they're more insulated. In the same way, you do that with everything else. So if you're buying a real estate company, you also want to look at banking companies. And a lot of that is trajectory based of what the economy as a whole is doing. And I hate to say this. I really hate to say this, but we're actually looking at defense contractors because of what's going around the world and seeing who needs to supply this stuff to everybody. And that's so the portfolio gets fleshed out in diversification based on macroeconomics and what's actually happening in the market. And that's not, I mean, I don't have a crystal ball. I couldn't tell you if logistics is going to do great, because we still need a logistics company. UPS, we covered them recently, and they're actually a pretty good company. It's just not yet to buy. So it depends on what's happening in the economy is the 2-second answer.
And a lot of that is what we do.
Yes.
Is we look at the news, we look at macroeconomically what's happening, rather than just focusing on the numbers and what the stock's doing up and down and the different charts.
Oh, and you guys love seeing that. Like every 3 o'clock in the morning, hey guys, did you see what happened with Apple? It's like 20 articles. You're trying to sleep. Good God.
I swear, you sent me a message at like 11 last night or something. I was like, why aren't you asleep?
I put my phone on mute at 10 so that none of his messages come through until the morning.
I mean, it's
there you go.
It's not intentional. It kind of is intentional. I mean, I wanted you to see that, oh my gosh, there's a lot that actually goes into this. And that's the challenge I have with this video. You ask these questions, and how do you condense all of that? I mean, you've seen how many articles that we go through and how much research that we do. How do you condense all of that into like a 9-minute, 10-minute video or something? And that's hard to do.
So difficult.
Yeah, and so let me repeat back kind of the methodology you were talking, because I was asking, are we looking for one industry, we invest in one industry, and then we say, what's the opposite? Or is it more, you're looking at the world as a whole? When you sit down and you say, I'm going to invest in something this month, when you sit down and you decide to do that, are you measuring it against what you already have in your portfolio?
Yep. Yeah, when I sit down to do it, I look at what's going on, okay? War is about to break out. Defense contractors should be the way to go. So you look at your portfolio. Do you have any defense contractors?
Or tinfoil hat companies.
Or tinfoil hat companies, or people who supply stuff to the defense contractors to make the tanks, the bombs, the guns. And if you don't, then you go to that industry and see, okay, which one is most likely to benefit from this? And that's how we do it. We just go into their financials, we go into what contracts they're doing, and at that point, we take an educated guess.
Side note, war is awful. It's horrible. I don't care what side you're on. It's bad.
Yeah, I hate profiteering from war, but it's just like the pandemic. When the pandemic, what is going to be the company that's going to benefit the most? And it was toilet paper companies and Zoom. Hindsight's 20/20 with these things. You can go back and make $1 trillion if you bet on all the winners, but you really do need to take a look globally, what's going on, what your portfolio looks like. Do you have those sectors? No. Do you want to diversify into those sectors? Yes. Go even deeper into the specific companies, go even deeper into the finances of the couple companies that you look at, and then pick one. And at the end of the day, I hate to say it, it is an educated guess, because you don't know if that company is really going to take off. But
it's a very educated guess.
Anybody says that they know for sure is lying.
I know for sure. I'm always right.
Yes, you are. Even when you're wrong, you're right.
Even when I'm wrong, I'm right about being wrong.
Great. So yeah. Love it. Really good pointers here. So I'm taking it to the realm of actual application. If I'm watching this video, which I kind of am, I'm the dude behind the camera here, you know. But let's say I'm watching this video. What should I be doing about this? Like, what would you recommend that a person does next? as a
Number
result
one,
of this.
watch our videos.
Save us, please.
We purchase a stock every month.
Yes.
Watch that video.
Also, vet us against your financial advisor. If you don't have one, get one. Get one.
Yep.
You need one. We
Have
can't,
him watch our videos.
I mean, we can't look at everybody's finances individually with over 3,000 subscribers, so we can't do that for you, but we can certainly supplement and potentially help you along the way. The second thing I'd like you to do if you're watching this is wait a few months so that you can see this happening. I've got a company, Honda Motor Corp, pulled up. It's our best performer right now, and you're going to notice something. Every few months, they have a peak and they have a valley. They have a peak and then a valley. Every time, you can see these trends that happen. And when we buy a stock every month, the reason why we say it takes time is because you can't just put $200,000 into a stock. What if we did that at Honda Motor Corp's high right here? You're not taking advantage of the 52-week lows or the dips or market sentiment or the crazy irrational behavior that you can see in the market. We can't control that, but we can take advantage of that. And we can actually use that to reduce what's known as the cost basis for your investments. It's kind of like going to the store and waiting until something is on sale before you buy it.
Exactly.
Unless you're going to Art Van, then everything is on sale. And they probably don't have Art
Every
Vans
day.
anymore.
It's the biggest sale of the year.
Well, Walmart, the little smiley face, there's always some sale somewhere.
So when they say ebbs and flows of the market, this is what they mean.
Yep.
So you're suggesting people wait for what?
To understand how irrational the market can be and how rational it can be at the same time. So the market typically anticipates what's going to happen 6 months ahead of what's happening. So if they wait, the only reason why I would want them to wait is just to see what happens so they understand what they're getting themselves into.
Right. And don't panic if you buy it and it goes down, because you're rarely going to actually get the low and you're rarely going to ever sell at the high. Maybe you'll hit it once in a while by mistake. I've done it just purely by accident.
There's a reason why all of our stocks have dividends and they pay dividends, because
Right.
it insulates us against that. But we try to take advantage, and we're pretty good at it. I mean, it takes some time, it takes some getting used to, and you have to learn a little bit. But we do that with our monthly stock purchase. So the first thing is get with a financial advisor. The second thing would be wait. And the third thing would be set a budget so that you can invest. If you don't have a budget and you've got an interest card that pays, you got an interest on the card that pays the credit card company like 11%, well, you're probably not going to beat that in the market. Most major investments.
How do you get a credit card that's 11%?
Well, you paid them 11%.
It's like 18 or 20%.
I don't have a credit card.
Oh, yeah, like 26%.
26, yeah.
What? We're buying Visa next.
Yeah.
Holy crap. This will tell you how disconnected from debt I am. But the point is that you want to go into it with both eyes open. In fact, even the crypto market will say HODL, I think, hold on for dear life, I think is their acronym that they use. And that's not too far from the truth in the stock market. Because if you look at even Intel, and we purchased them last year, yeah, right there. So September 15th. It looks like they're doing really good for us, which they are. But if you had owned that stock for 5 or 6 years, look at what happened. Oh my gosh, they went way down. But remember, they paid a dividend the whole time. They cut their dividend once, but they still paid it. So we still get a dividend check. But what happens if you go back even further? So let's go back to, 2004. Go internet. All right, so if you go all the way back then, look at all the D's.
Those are all dividend payouts.
Yep.
Money in your pocket.
Yep. And you're also going to notice something. Every 3 to 4 months, it does this. And you can time it close, like Brian says, but you're never going to hit it right on. But if you can lower your cost basis, that means that's more money in your pocket. You get more money per dollar because your dividend check is bigger relative to the profits of the company and everything else than if you would have bought it if they were trading at their high number way up here.
And this is why they say time in the market always trumps timing the market.
Yes, and also that's also why we buy companies that make products that people have to have, because you can pretty much guarantee that, like the redneck with the pickup truck, that you've got a backup plan that probably will work as long as you can get the quad out of the back of the truck. How would you do that? So a bunch of America's Funniest Home Videos about that, people trying to do that.
You just done it. And it goes,
But that's the point, is you have to buy a company that has a stable foundation or defensive moat. And the only way to really do that is to pay attention to what's happening in the market. Or you can do what everybody else does, buy an index fund, buy an ETF, and you probably won't do too poorly or too badly doing that. You're just not going to beat the market, which if you're going to do that, it's going to take a lot of work. This just doesn't magically happen. There's no money tree outside that the money falls off of.
Right.
It does take time.
Love it. And I also like the first thing that you both said was subscribe to the channel. You should definitely do that because we're doing this all the time. We're just warming up here. So go ahead and subscribe, and we'll see you next video.